we'll have to understand how the economy moves through various economic and business cycles, and therefore how the interest rate moves along with the economic cycles. So there are typically four economic cycles. The first is the recovery cycle. As the economy moves from a recovery cycle into an expansion cycle, and then after the expansion cycle, it moves into a late stage cycle, and finally into a slowdown or a slump, and then the recovery cycle starts again. So there are these four cycles which keep on repeating in a business cycle. Now, the current phase where we are, last 2 years we were in a recovery cycle, and typically, what happens in a recovery cycle is that the economy initially is in a very slow growth mode, but the central banks, cut interest rates. They ease the liquidity in the market, effectively making the markets with surplus in liquidity. The characteristic of a recovery cycle is that inflation is low. The sentiments initially are, very, very, tepid, and the uh, the companies want to deleverage, households want to deleverage. So during this phase of this recovery cycle, credit growth is also very, very weak. So this is the phase we saw in the last 2 years after the COVID. However, when you move out of this recovery phase into an expansion phase, and the characteristic of an expansion phase is that the confidence is back in the economy, uh, the earnings of the corporates, they start to improve. Uh, the general capacity utilizations, they start to close in. The credit growth therefore also starts to improve, and the Reserve Bank of India wants to then take the policy rates to neutral as the inflation also starts to move up. So this is the phase we've seen over the last 6 months, where after the COVID, the economy has moved into an expansion cycle. The shape of the curve is also very different. In a recovery cycle, the curve was very, very steep, effectively meaning that the short end of the curve, the 1 year rate or the 6 month rate, were anchored around the RBI rates, which was at around 4%, a year back. Um, However, the longer end of the curve, they are at a much higher level. So 10 year last year was at around 6.5% against the 4% of 1 year. And therefore, the shape of the curve was very steep. That's the nature of the recovery cycle. But as we move from a recovery cycle to an expansion cycle, the curve starts to flatten because RBI starts to raise interest rates. So we've already seen that RBI has raised, uh, interest rates to 540 on the repo side, and effectively there's expectation that he'll raise rates more. So typically he would want to take rates to a neutral territory, effectively meaning that since the inflation right now is clocking at around 6%, on a forward-looking basis, RBI would want to take rates to that zone. And what happens during this part of the cycle is that the curve starts to flatten. So what we've seen is while the 10 years still trading at around 720 uh, kind of levels, the 1 year part of the curve has started to move up. So you're seeing that the 1 year CD, which was trading at 4% last year, now trades at 680. This is a typical nature of expansion cycle with the curves being very, very flat. Um, so from that perspective, where does one invest? One invest in this part of the cycle also changes. Effectively, we believe that in this part of the cycle, RBI will take rates to neutral, possibly slightly over neutral, given that the macros at this point of time are pointing to a very high trade deficit. Inflation is also ahead of RBI's comfort zone, so they may take rates a little above neutral, but then at some point they will pause. So which is our view right now? The repo rate is at 540. We expect repo rate to go to 6% and slightly above that, and RBI to stop at that point of time. So we have already seen, the markets react to a part of the RBI rate hiking cycle. What I think is still not happened is that the liquidity change which is happening from the recovery cycle to the expansion cycle, that has yet to feed into the market. What I mean by that is that when the liquidity tightens, your liquidity premiums in corporate bonds, in AA credits, they start to expand. And this is what I expect to happen over the course of the next 3 to 6 months. At this juncture, the spread between corporate bonds and Gsec is very, very tight. But typically, when the credit growth starts to improve, you would see that these spreads would start to move up. already banks are pushing ahead for higher deposits, to shore up their balance sheets, and therefore there's already pressure on the wholesale deposit on the banking system. So I think all of this will start to feed into corporate bond yields as well. And the next 3 to 6 months, the corporate bond yield should also start to become very, very attractive. Now, from a investor's perspective, what is important is that, while in the recovery cycle the curve was steep, there was some value to move ahead in the on the curve in terms of duration. So possibly a 3 year, 5 year, 7 year, 10 year, whatever duration looked appropriate from a carry point of view. At this juncture, the carry on the curve has been absolutely negligible. Effectively meaning that if you add duration to your fund, you're not going to gain any carry. So therefore, from that perspective, there's no point to add duration in this part of the cycle, which is the expansion cycle. And what you should do in this part of the cycle is to invest in the short end of the curve, which effectively will give you a good carry, and also not you will not be taking unnecessarily duration risk during this part of the market cycle. What also will become very attractive is the short duration accrual assets. As the liquidity tightens and the credit growth improves, the accrual part will start to deliver much higher YTMs, and which should happen, I think, as I said, in the course of the next 3 to 6 months. So that strategy will become a very, very attractive strategy for the investors. So in an increasing interest rate cycle, it's appropriate to invest in funds which unnecessarily do not give you, any negative capital risk. And effectively, therefore, you should be invested in short duration funds, and you should be investing in funds which have floating rate kind of strategies, because floating rate strategies, they kind of take care of rising interest rates, and therefore your returns get adjusted. But it is important that you do not bite long duration at this point of time. What I've been hearing in markets from a lot of investors and distributors is people ask the question, what is the right time to invest in the 10-year Gsec? I don't think that in the expansion phase of the economic cycle that we are in, it is appropriate to add duration risk. Possibly you can trade the duration risk at some point of time, but I don't think investment in duration is the right strategy. The reason is simple. The RBI is going to hike interest rates and pause. And I'm not seeing RBI cutting interest rates at any point of time. So unless the view is that RBI will cut interest rates, which I don't think happens in this part of the economic cycle, there's no point to add duration. Also, from a carry point of view, the duration assets don't give you any additional carry over the short duration assets. So I think this question, when to invest in duration, is an inappropriate question at this point of time. And I would not recommend investors to look at the duration assets at all. I would suggest them to only stick to short duration assets at this point of time in the market, and write the carry and the accrual in the fixed income funds. The carry in the fixed income funds has already become very attractive. What used to be a 4%, 4.5% YTM, has increased to almost 7%, 7.5% of YTM in a large number of funds. And I think this YTM is only going to improve in the next 3 6 months. So I think the YTM will be the biggest part of returns for the investors, whereas duration will only add volatility to their portfolios. So my thought is very clear that accrual strategy, short duration strategy will be the best strategy to invest in this part of the market cycle. So the return on the debt funds largely will be guided by the YTM of the funds. So one should look at the YTM of the fund while one is investing in, and one should not take inappropriate duration risk, because that can bring volatility to the returns. So therefore, funds which have a decent carry, a decent YTM, they should deliver, I think, returns around their YTMs, and therefore, I think as the YTMs are now improving. So if you look at the curve, the 1 year CD is already at 6.8%, and I expect 1 year CDs to only go higher. So if the short term interest rates are moving ahead of 7%, then I think it becomes an attractive asset class